Good morning, everybody. It's great to have this opportunity to talk to you today. My topic is investing at a tipping point. The biggest risk I believe we face in South Africa today is that we are at a crossroad. An economic, a social, a political, an environmental, and even a technological crossroad. And the risk with a crossroad is that it gives you uncertainty about what direction you're heading into. On any of these matters separately, how they intersect, and then how they all add up. Now, interestingly, all of us today face these crossroads with multiple identities. We are citizens, and we are business leaders, business owners, we're employees, we're parents, but today we're investors. And crossroads present this risk of the unknown, but they also present an opportunity. So what's important about trying to figure out where we're going from this crossroad is trying to also figure out or understand where we've come from, where we are, and also how we got here. Now, I think the most interesting thing about South Africa is even though it feels as though everything's just happened to us, and it's just happened to us quickly, in truth, it's been happening over a very long period of time. And we can decide to choose when that starting point is. Is it the democracy? Is it the last 12 years? Is it all the accumulation of issues from generations before? But the point is, just like when you put frogs in lukewarm water and you just turn up the temperature bit by bit, actually issue over issue has just contributed to South Africa reaching this boiling point of this crossroad. And so, I mean, Kevin's done a brilliant job earlier, and all of us, in fact, today will speak about the issues that we face, where we land today, long-standing, well-known, deep structural issues. The situation we have in terms of just our finances as a country, how we got here, how COVID accelerated the decline. We came to this COVID war already wounded. Fortunately, we've had commodity prices that have bought us some time, but perhaps one of the biggest issues is the inequality, the intractable fact that so few people control so much wealth. In fact, the scary statistic, 3,500 people in South Africa own more than 32 million. Unemployment, Kevin did a brilliant job again at explaining particularly the issues with youth unemployment and then very low levels of fixed capital investment. In fact, the SARB itself showed the lowest we have among all emerging market countries. And so it's no surprise against this backdrop that we have the really distressing events that happened as we saw, obviously, in July, particularly in KwaZulu-Natal. So just 6 weeks ago, the New York Times had this as a feature article, South Africa is falling apart. A truly sobering read. And you can understand exactly the kind of scenarios that were painted from there. Interestingly, one of the best known scenario planners and futurists in South Africa, none other than Clem Santa, almost exactly launched a new book called Thinking the Future. And in there, he paints two scenarios, rather lean on him as the top scenario planner, in terms of where South Africa could be heading. He painted scenario one, which he called the people's economy. It really is about something that says we have to work together to build an inclusive economy, one that focuses on a young generation of entrepreneurs, creates economic freedom for these entrepreneurs. And in fact, big business is not going to be the big employer, but rather it's going to be small business and smaller businesses. The second scenario is the one that we seem to be more focused on day to day as citizens and as investors: rising anger, extended inequality, a stagnating economy, and of course, continued disunity, which is what we experience. Fortunately, he put the probabilities of being, hopefully, if we all collaborate and combine, 2/3 more likely to be scenario one, which is the people's economy. But the truth is, no matter which way we go for South Africa, some things are going to be certain. And the one thing that's going to be certain is, notwithstanding the contribution that technology has delivered to just growth across the world to this point, it is still going to be a significant driver of growth going forward. The United Nations recently put out a report, and here this chart really shows their expectation for the explosive growth they predict in frontier technology, so things like the Internet of Things, robotics, etc. And they show these numbers growing about tenfold over the next 7 years. Or over the 7-year period. And I think importantly from this is it's driven from how we're all talking to you today: widespread connectivity, making things possible that were just not possible or even contemplated 5 years ago. Now, the good thing is that those countries and companies and businesses and entrepreneurs that take advantage of this opportunity will no doubt flourish. But sadly, for developing countries like ourselves, who are not set up to use, to adapt, to adopt, we're going to fall behind. And unfortunately, as we know, South Africa already has a mix of profits. As my colleagues before me have articulated, we are a commodity-producing export country. At the moment, right now, almost half of the profits of the South African market are resource companies. You can see the splits in terms of how small a share of the technology profits, for example, are in our mix of companies that is available to invest in. And so, also importantly, is that this is a period of the last, over 20 years. And if you look from 2007, really our profits have gone nowhere. And this is including the effects of high commodity or rising commodity prices of late, and then the boom we got from the contribution of the likes of Naspers through Tencent's explosive growth. So it's this continuation of low earnings growth in our country. Now, it brings us to a dilemma, because as we stand here today listening to everything you've heard this morning, it's almost as though you face this as to, why bother with South Africa and South African equities? And you really have two decisions that you're facing. How much should you have of domestic equities if you are in an opportunity to, be multi-asset class? Or within domestic equities, how much should you own of South African domestic equities? And in truth, if we were only managing global equities, we probably wouldn't bother that much. We would cherry pick a handful of South African stocks. But the truth is, for those of us that are now facing the domestic equity universe, none of what we shared to you today is news. Almost all of this is known. Last week, or it was the week before, the editor-in-chief of the Daily Mail had an interesting, of the Daily Maverick, I should say, had an interesting comment, Branko Brick, and he said, let me read it. He said, to say that our country is in deep trouble is to echo the voices across society. But in truth, some of us can do more, and indeed should do more. And this is where I think us as investors has a role to play. So active investors have actually taken quite a beating over the last couple of years in terms of our role. But perhaps now more than ever, I think active investors have a role that goes back to the very edge of their differentiation. And that edge is exactly this. We have the ability to choose. We have the ability to use our insights, to use our judgments. Most importantly, we now have the ever-increasing ability to engage, to collaborate, and to influence. And so my question, and the actions I think that active investors now have, are to use the exact information that all of us have available, that is not news, as depressing or as concerning it might be at this crossroads, and say, how do we apply a second level of thinking and insight into this same information and perhaps come up with different solutions or next steps? So one of the things that we've been doing at Perpetua is that we've really been looking at having a plan on how we do this. And while I've got some of the points on this board in terms of how we assess and engage separately in terms of South African companies we invest in, two things that I wanted to flag are points number 5 and number 6. For quite a few years, for generations actually, and decades, South African management have had this kind of convenient ability to have very strong market shares, particularly in the listed space. And so we think that this is a time now to really engage and assist in understanding how to enable management to adapt their thinking, to be agile and nimble. And secondly, a critical thing is that to understand where businesses can benefit without necessarily being completely wedded to the macro, which we all know already isn't good. So is there an ability to unlock value through turnarounds, through new business opportunities, to restructuring, self-help, selling assets that's not necessarily wedded to how well the economy is doing and which scenario might turn out? And so for that reason, if you look at our current funds, we actually still have quite a high percentage exposure to South African Inc. shares. What you don't see below this is in that red section is how that's changed. And I'll touch just now on where our sector overweights and underweights are. I think what's different today as we stand here, in September 2021 versus September 2020, is that a lot of the easy money from some of the cyclical recoveries has been made. So now the points that I mentioned on the previous slide are even more relevant in our ability to engage and act with management. So in our portfolio, I'd say some of the key differentiated things that we're doing is that we are more overweight industrials than we are resources. We do own resources, but we're not overweight relative to their typical benchmark weight. what we noticed is that this has given our portfolio to source really undervalued ideas. So our portfolio is incredibly cheap. It offers strong upside and very good compounding returns. And importantly, we think the risk of the return is far lower than that of the benchmark, which currently now has a high exposure to companies that are on cyclically high earnings. Importantly, when you are at a very heightened negative sentiment cycle or positive sentiment cycle, the idea is to actually shift to focusing on the fundamentals. And when we as active investors have an opportunity to influence those fundamentals, that's exactly what we should be doing. One of the hallmarks at Perpetua is what we call our true value continuum. And simply all it does is it shows you three things. It reveals to you that there's always more than one reason that a share will be undervalued. It could just be, a mean reversion, or it could be something that would be a quality stock that's just, fairly priced. Secondly, every single stock in the South African and global stock market will move up and down this continuum. And the idea comes to our third thing, is that Perpetua seeks to typically only invest when it's along the continuum on the value part. We just feel we don't have an edge trying to figure out when very high cyclical things are going to continue to remain in vogue and in favor before they start to correct. And so a big chunk of our portfolio right now, which is delivering very attractive compound returns over the next 4 years, is sitting in that hardcore value space. How is that represented? Well, actually, not different to Malungelo, we are quite overweight general retail, but actually the big shift was that we were also very overweight banks last year, and we're now underweight banks. Placing our bets in the banks that we think are the ones that have the ability to really pick how they participate and activate their right to win in the kind of scenarios we see going forward. Also, quite a lot of opportunity in some recovery ideas and some of the hospital shares, etc. We are underweight platinum counters. And again, this has been largely due to where we believe they sit on the continuum. Our top 10, as you see here, quite a mixed bag of some industrial shares, some of the banks that we've chosen to place our bets in, some of the retailers, and then obviously also some of the resource companies. So they're particularly Glencore and RB Platinum. And so, this brings me to my final points, which is in terms of the mitigating actions. One of the things that one runs into a risk of when you're faced at an uncomfortable situation like we are today is that we think that everything's changed. And in fact, the whole heartland and the cornerstone of investing is that there are some things that remain ever constant. And those are the times, and particularly at this time, is when you go back to that. Now, with the kind of scenario we heard earlier in terms of the South African economy, the ones that, I think I'm the fourth person to have spoken about, the nightmare in terms of our youth unemployment, etc., one might be very under pressure or encouraged to just flee in terms of, well, physically if you're a citizen, but also in terms of your money. And diversify at all costs, even when there's actually value and opportunity to be had here. And so, but ultimately it always comes down to one thing. Irrespective of where those stocks are listed, it's about their hit rate versus diversification and understanding the balance. While diversification might be the hallmark of investing, it really is about generating outperformance through owning more winners than losers. And the error that we could have right now, as if we're too macro concerned, is by focusing too much on the diversification and not enough on where the potential future winners are. And so a big part of our role we see as active investors right now, perhaps more in the next 5 years than have ever been in any kind of 5-year period before, is our ability to engage, understand, and connect with these management teams and explain to them how we see the world of whether it's ESG, whether it's e-commerce, whether it's future technologies converging, and let them understand that we're not short-termist and that they don't have to force the metrics of their business through an archaic, income statement and model for it to make sense. And so we really are focusing on owning businesses that are not at cyclical highs today, but have higher future values, because it is, after all, again, another constant, which is compounding. And then lastly, it's about timing. So are we at the tipping point? I would say we're at a tipping point. And so from this perspective, I think the important thing is, how do we use this opacity about the future to take an opportunity? We see that opportunity as active investors in South Africa to use our position of influence and use this timing to actually bet when the odds are in our favor, not just based on a macro theme or a fear, but based on the insights of the work we do. And that's all I have to say today. Thank you.